Look at any vibrant market in an emerging economy, and you'll see that money moves fast. Goods change hands, services are rendered, and physical cash flows constantly from person to person. But zoom out, and a massive inefficiency appears. Billions of dollars in these economies sit outside the global financial grid. This is dead capital, assets that sit under mattresses or inside lockboxes, unable to accrue value or earn yield. It creates a frustrating paradox. You have millions of people participating in a high-activity local economy, but because their profits are locked in physical paper, they have no mechanism to accumulate long-term wealth. Physical cash isolated from digital networks acts as a strict barrier to economic momentum. It traps savings in a state of suspended animation. Historically, the primary tool for moving cash into the banking system has been the traditional ATM, but these machines function as simple dispensers, built solely for basic storage and withdrawal. This image shows an old savings passbook, and it reveals the actual outcome. When cash does enter legacy banking systems, it often becomes a static ledger entry. Look at the handwritten transaction dates and the near-zero interest. That money isn't growing, it's losing purchasing power to inflation. Accessing even these basic services requires immense patience. Traditional banks cannot cost-effectively scale brick-and-mortar branches to reach rural areas. Instead, workers are forced into stagnant queues, spending hours of their day just to deposit a few bills. A mid-20th century physical banking model, dependent on concrete branches and paper ledgers, is the primary driver of modern financial exclusion. Sigma Bank AI bypasses the need for new physical construction by re-engineering the pre-existing footprint of standard ATMs. If you deconstruct a standard ATM's architecture, you can insert a new digital layer for identity verification and secure digital tracking. The most significant integration happens at the base. By installing a smart contract engine, the physical kiosk connects directly to decentralized blockchain networks. This technological stack compresses the full capabilities of a bank branch, handling identity checks, managing asset conversion, and guaranteeing secure routing into a single automated footprint. Transforming the ATM into an active digital node removes the physical infrastructure barrier to modern banking services. To see this in practice, let's track Amina. She takes her daily earnings and feeds the physical currency into a Sigma microbranch. The machine converts her deposit into liquid tokens, one-to-one digital claims on the blockchain. The paper is stored, but its value enters a borderless network. Her wallet automatically splits these tokens between a savings vault and a global decentralized finance pool. By converting paper to tokens, a singular physical deposit at a street corner becomes an instantly deployable active financial portfolio. Compare Amina's yield-generating portfolio to the idle cash we saw at the start of our story. Her deposit is no longer dormant. It provides liquidity to decentralized markets, earning returns that outpace local inflation. When you multiply Amina's transaction by millions of similar deposits across entire continents, these networked nodes generate a massive pool of aggregated liquidity. Replacing dead capital with this kind of living liquidity allows emerging markets to integrate their local savings directly into the global financial stream. This upgraded Sigma ATM sits right on a local street corner, providing a direct point of entry into the global financial system. Democratizing finance at this scale is a matter of technological conversion rather than the physical construction of bank branches. When everyday cash is tokenized, it transitions from a static asset into a moving force within the digital economy.